Let's look at the following journal entries for these transactions. Moon Inc. is a new corporation that started on January 1st, 2023. The following transactions occurred during the first year of operations. Let's look at these transactions. A. On January 1st, the owner invested a total of $60,000, the par value of the stock, to start the company. The corporation issued 16,000 of shares of common stock in return. Transaction B. On March 14, the company purchased equipment using cash for the cost of $8,000. Transaction B. On May 12, Moon Inc. got a note from the bank for $50,000. This is a loan they took from the bank. Transaction D. On June 15, the company paid cash to its employees for their salaries, and this amount being $15,000. Transaction E. On July 13, Moon Inc. made a payment of $10,000 towards the outstanding bank note balance. Now, let's look at the journal entries made for this. Now, I'm going to move them so it's easier for you guys to see. Here we have the first journal entry. I'm going to move it right here, and you can see that cash is the account affected, as well as common stock. Cash is a asset account, so it would increase with a debit. So I debited cash for 60,000, and then I moved common stock to the credited area, and this is because it is an equity account, and equity increases with credit and decreases with debit. So I moved it to the credit account because it is increasing 16,000. Now let's move to the following transaction, transaction B. I'm just going to move this one here so we can remind what each is. So transaction B, on March 14, the company purchased new equipment using cash, and the cost being $8,000. So the transactions affected here are equipment and cash. Equipment is also an asset account, so it will increase with credit, it will increase with debit and decrease with credit. Since we're getting new equipment, we're increasing equipment by $8,000, and since we paid cash for it, we're decreasing our cash account by $8,000. Now, here, transaction C. On May 12, Moon Inc. got a note from the bank for $50,000. This is a loan, and the accounts affected would be cash, an asset, and then notes payable, which is a liability. We now owe money to the bank. We have a note from the bank, and we need to pay them back at a certain time, at some point in the future. So we did obtain cash, so our cash account is affected and is going to be debited because it is increasing. Now, notes payable, it's also increasing, but because it is a liabilities increase with credit, we're going to put notes payable on the credit side, and it's still increasing, but since liabilities increase with a credit and decrease with a debit, we're just going to put them there. Now, the following transaction is transaction D. On June 15, the company paid cash to its employees for their salaries, and they paid $15,000 for this. Now, the accounts affected would be salaries expense, which would be the expense the company's paying their employees. So it is essentially a expense account, and expenses decrease with credit and increase with debit, so they act like assets account. Here the expense increase and we paid cash, so cash decreases by 15,000. Now transaction E. On July 13, Moon Inc. made a payment of 10,000 towards the outstanding bank note balance. So this is coming all the way back to transaction C, where they first got the note from the bank. Now they're making a payment towards the note. And the accounts affected here are notes payable, which is liability, and cash, which is an asset. Now, notes payable is a liability, and liabilities decrease with credit and decrease with debit and increase with credit. So since we're making a payment, we're decreasing the amount that we owed, and since it's a liability, we would put this 10,000, this amount here, in the debit side. That's what I did there. Put the 10,000, decreasing our liability by 10,000. We now owe only 40,000 to the bank, and we're decreasing cash by 10,000 because we made a payment. This is all for today. I hope you enjoy my video. Thank you.